This is part 2 of my interview with Ivana from Spear Alpha ETF, SPRX. I asked her some very direct questions like, why did you sell Tesla stock? Should you own quantum computing stocks? What are the 3 best momentum stocks to buy right now? All this and much more, here it is. So this brings up a great segue. I'm gonna put you on the spot a little bit. I don't think you're gonna mind, but I have a question, and maybe I'm wrong. I just looked before we started at the current holdings of SPRX, and I didn't see Tesla. And I know that you mentioned robotics, and on the on the website, if you go to your website, it says it's one of the focuses is robotics, right? So is there any reason you don't own Tesla? Did you own it and sell it, or what's the situation there?
Yeah, so we owned Tesla going into the election, with the thesis being that autonomy is going to be a huge deal, and the regulatory environment, if it changes and it's supportive of autonomy, is going to be a game changer, right? Now, that was true for a while Elon Musk and the current administration were aligned. The moment they disaligned, all of a sudden, our thesis changed. And what we do is when our thesis change, our position changes. So this is like one of the ideas that we had to cut. We made a decent profit since we bought it but we basically had to cut it because the thesis changed. And really, if you look at robotics, not so much robots, but autonomy, which is the more near driver for the stock. If you look at that, that's very regulation dependent, right? So the thesis, like if you can basically just allow autonomous vehicles in the US nationwide, that's one situation versus if you have to go county by county and get pilots tested. So in terms of like the math, if you model it out of like reaching that scale in 5 years versus reaching a scale in 30 years, it's a very different value proposition and return profile for the stock. So that's why we cut it. We're evaluating it. So if something changes on the regulatory environment and it is actually allowed for autonomous vehicles to be on the roads without much friction, I think the upside is really pretty high there. So a lot of this application layer, if you go back to the chart, a lot of this application layer, it's really in this process of determining whether there is upside, how long it's going to take to get that upside, right? That's one of the bigger deals, and whether there's going to be some other disruptor that comes in. So with autonomy, one thing I would say is that the technology is there on the NVIDIA side as well, right? So NVIDIA has an auto segment that does offer autonomy as a tool that companies then have to take and train. So Tesla has a unique advantage because they're a first mover, right? So that's why it's so important that they can scale quickly, right? Because if you have to wait 30 years, by 30 years, somebody else may come in. So that's basically how we think about it.
Yeah, and it goes back to the point about flying cars. If it's going to be hard with autonomous cars, imagine flying around with no roads.
Yeah, I mean, imagine how hard it's been because, like I went to a presentation, I think it was 12 years ago from Delphi. Now it spun off and they showed a car that was going from coast to coast autonomously, right? Mm-hmm. Now, that concept was like, there was a car, I saw it with my own eyes, right? But to bring that to reality, it's now been like 10 plus years and there is very little progress, right? Like baby steps. So, and in investing, the time is really what you're going for. So it is very important. Like a lot of these ideas that sound good, it's very different if they're going to play out in 5 years versus 30 years. This idea that people pitch where it's like, oh, I'm a long-term investor, I don't care. That's just not a good way to invest because by year 10, the landscape and the lay of the land may look very different than what you were planning on. So to your point, researching constantly and making sure that you are in the right trends is really important.
Yeah, I mean, that is just perfectly fits into the whole conversation we've been having in our community about adoption curves, because adoption curves also is going to include legislation, rules and laws and taxes, and or not taxes, but counties and all the different regulations to get things approved. But then it also, if you look at technology curves, Apple, the iPhone, smartphones in general, were one of the faster curves. And you get the argument a lot of times like, well, if you think of, I do the historical comparisons, and this is not technology, but if you look back to Coca-Cola and M&Ms. So if you go back to World War II, if you really study what happened there, we were putting things like M&Ms in the rations for army soldiers because the chocolate with the candy shell wouldn't melt. And so they had an agreement, and there's tons of companies you can talk about like this, where they have agreements with the US government. Coca-Cola built distribution centers in factories all over to support the troops that were basically stationed overseas for war. And for just, if you look at that and you do some research on it, it shows that the adoption curve was accelerated, 10 to 20 years for something like that. And this isn't technology. This is just like food product. And basically, if it weren't for World War II, there are a lot of brands that might not be the same, because you could say, well, it still would have happened, but it would have happened 10 years later. Well, it could have been completely disrupted by another company within that time period. And so there's so many moving parts to an adoption curve when you think of technology. And you can say, well, there's technology moves faster, which it does, right? Because social media and more people are connected. You think of like satellite, Starlink connecting Latin America. Like we're big on Mercado Libre, which I know it's kind of out of your wheelhouse, but e-commerce and thinking about all the total addressable market for Latin America. But the thing is like, even that technology isn't new. It takes time to adopt. So even if Elon says, I've got an Optimus that's ready for sale tomorrow, it's going to be crazy expensive. Only a certain percentage of people can afford it. And there's going to be a long curve, like AR, VR goggles. I mean, these things have been around forever, right? And people are still pushing like, oh, we're going to do these meta glasses. Maybe, but like I said recently on a podcast, your kids might be into AR and VR, but we're creatures of habit. Am I going to start strapping one of those on and walking around the house? Probably not. Are you? Probably not. Are your grandparents, your parents? Probably not. Your kids and their kids and their kids, but this is a long adoption curve. The average adoption curve, it's 5 to 10 years is an accelerated adoption curve. And then you add the laws to it. And so autonomy, I mean, it still has several years, but to your point, it's been going on for a decade. This isn't just like an overnight thing. And so you hear these things like, oh, well, this company is building this cool robot or this cool widget or this cool flying car. Investing in those kind of stocks, the hit rate is so damn low if you really understand it, right? And not saying you can't make money, not saying the stock can't triple from here because enough people believe the same hype and they buy it, but the fundamentals still aren't there. I mean, you can say that a lot of these meme stocks that are, the fundamentals aren't there, but it's a market, right? If more people want to buy it than sell it, what's going to happen? The price is going to go higher. It doesn't necessarily mean that the fundamentals have improved, and most of the time they haven't. And it doesn't mean that in the next bear market, it's going to be, more than likely it's going to be down 70% from where it is now. So this is really good. So autonomy, I agree. What's your time frame with Tesla? If the stars align, what's your time frame where that's available to the masses? And then what do you think the adoption curve looks like for the average person like me saying, you know what, I'm going to go buy a Tesla because it has full autonomy? What is that? Just a guess. And I know some of you watching are mega bulls on Tesla. We're not trying to pick on Tesla, but we're trying to be realistic with this. What are your thoughts on timeframes from here for autonomy?
So what we had in our model when we were invested in Tesla was that in 5 years, they're going to reach scale in terms of revenue generated from robotaxis specifically. Now it looks like it's more like 10 years that they will reach scale. So that could change, right? A lot of it's not. So I think for Tesla specifically, they've been making cars, so there's not that much risk that they won't be able to scale the production. I think that we're pretty confident on that. It's really more about the regulatory environment, right? Where like if you have to go county by county, that's a tough game. So at some point there was some talk about making a nationwide push towards, hey, like AI regulation will be at the federal level rather than letting the states decide on them. So that would have been really positive. But if none of these things are going forward, I think it's going to be a much slower adoption. And then you're looking at that compared to other ideas in our portfolio where there is actually more immediate earnings upside. And that's really how it, like if Tesla was the only stock you could invest in, I would totally invest in it, right? Like in the technology space, there's no question they're going to do well, and Elon Musk is brilliant. So it's not from that perspective. It's more a question of like, okay, how much money do you think they're going to generate in the next 5 to 10 years? And how does that compare to other companies that we cover?
Do you think that the new comp plan, you're talking about $1 trillion comp plan, 2035. Do you think that, what do you think about that? Is it just insane to you? Do you think that's going to help motivate Elon to maybe make this stuff happen sooner? What are your thoughts?
So my thoughts in general on comp plans is that as long as they align the CEO's incentives, they're fine, right? People are like, oh, $1 trillion. Tesla will be nothing without Elon, right? So there's really no way to use the technology and put another CEO. So when you're in that type of situation, you are kind of want to pay up for the talent. And it's same thing with like AI talent more broadly. People are paying really crazy amounts. It's because it's in high demand. So, there's no right or wrong. The market decides what the right thing is. Like imagine what would happen to Tesla stock if Elon Musk quits tomorrow.
Yeah.
Right. So it's really like, I think the market kind of decides these things. It's hard for somebody from the outside to sit and say like, hey, that's just way too much money. Like, no, it doesn't make sense. It goes by like, hey, how much value are you bringing and what like are investors willing to pay?
So you don't see it being like an Apple type situation where you lose jobs and Cook comes in and does pretty well. You don't see that happening with a Tesla.
No, it's just way too early. It's just like basically this autonomy has been around for like the thesis has been around forever. So people think like some people think of it as like an established business, but it's really a new thing. Like it's really just almost like year one, if you will, of autonomy where we are today, in my opinion, right? Because a lot of what we've had so far hasn't really been working at scale and at cost, at a reasonable cost. So I think we're in the very early innings, and you do need a founder mentality when you're so early. I think in like once it's scaled to multiple billions of dollars of revenue on the autonomy side, then you can have like a more corporate type individual head the company. But right now it's like just way too early innings, and you really need a founder.
Well, Derek wanted to know about that, and I've got one more question here. This ties together well. We just talked about adoption curves. We mentioned 5 years, kind of a guesstimate. Maybe it's 10, maybe it's 5 for autonomy. We're talking about robotaxis, fully autonomous. So this question's from Tony C, VIP member in our community, first patron ever actually. He says, can you ask Ivana, given SPRX's actively managed approach, how do you think about allocating to long duration secular themes like quantum computing, where commercialization might be a decade away?
That's a great question, right? So basically, we have a very specific risk model that addresses investing in this more speculative theme. So quantum computing would definitely fall in that category, right? And what you really want to do is you want to limit your downside by investing a small percent of your assets. Now, you also don't want to keep sizing them down, right, when they are on the upswing, which makes it challenging. So it's almost like trading options with these stocks, because at some point in time, they become very large percent of our portfolio. And then at some point in time, they kind of adjust back to below 5% positions. So we try to let them ride as much as possible within our risk parameters. But basically the idea is, if you have conviction in it, which we do, I think the idea is you still can't really bet the farm on them, right? Because they really are not generating profits today. So you are really making one of these like longer term bets. And the key is to just minimize your downside exposure exposure, because for us, like if we lose like 3 to 5% on a stock, that's completely tolerable. If we lose on a small stock, right? So like if even if the entire team is wrong and the stock goes to zero, if it's a 10% position, that's not necessarily tolerable. So that's basically how we think about it. It's managing the exposure because of their volatility, they go from like a large percent to like a normal kind of a smaller percent of our portfolio.
And that's where we align in many ways. The fact that, again, you're kind of treating it as spec and we don't want to go too heavy. And we always say spec 10x or 0. You get like a 10x, it goes to 0, but it's not going to kill you because you don't have a 10% weight. So, I mean, there's so many things that overlap. And Tony actually has another question. And we talked a little bit about this earlier, but you know, SPRX is actively managed. You would define it as actively managed, correct? And you can rotate those positions, those holdings rapidly, and you don't have to pay taxes like someone in a taxable brokerage. Would you describe the fund as primarily momentum driven or both more focused on holding through multi-year secular trends with tactical adjustments along the way?
Well, interestingly, those two things are not one or the other. So when we analyze our momentum exposure, and it's generally pretty high. So, and by momentum, momentum is like different people define it differently. We look at it as how many days has the stock been up? So like, and it changes over time, right? So for example, right now, like the networking names have very high momentum factors, right? But like if you looked at quantum computing, for example, 3 months ago, their momentum factor was actually very low because they had gone nowhere for a long time. So it's a very nuanced question because it depends on how do you measure the momentum. So what we try to do is try to stay balanced and not have the entire portfolio be hitting highs, right? Because that would be high, that would be all momentum. But then each idea is really based on a value approach. So it's not really like we don't really have ideas that we chase based on no fundamentals. So every idea that's in our portfolio, there is a fundamental thesis for it. And the same way I described the Marvell thesis, the Tesla thesis, if the thesis changes, that's when we make changes and we try to replace it with other ideas that have better risk reward. Risk reward is one of the most important things that we look at. So each stock has like, hey, this is my upside case scenario and this is my downside case scenario. So you also want to be balanced in that. Like you don't want to own stocks that are all like upside 10 times, but then also like downside halves, right? So the idea is to balance across that. And that's kind of the idea of like investing with an active manager is because they can adjust the exposure.
So, I mean, to try to simplify that, it's a little bit of both. I mean, you're trying to hold through secular trends and themes, but it's definitely not just like a buy and hold forever. It still has momentum driven factors, and you're trying to do a combination of momentum and secular at the same time and not going too overweight with just high momentum. Right? Am I hitting that?
Yeah, exactly. I would agree with that. Yeah, and I think sometimes people like think of momentum as like meme stocks. It's really not that, right? It's basically a definition of how much something has been up for a period of time, and that's how you want to manage it. But it's one where like different people measure it differently. My kind of school of thought on momentum comes from Citadel. They were really the first ones to apply these risk models during the downturn as we were emerging from the financial crisis. They really tried to step up as like everybody's portfolios blew up, right? With the financial crisis, they tried to step up their understanding of risk factors.
So just real quick for the audience, name three stocks that you would consider high momentum right now.
So right now, like the networking stocks would be very high momentum, right?
ALAB.
Astera Labs, Credo has been on fire. So anything that looks like the chart is going parabolic, that would be high momentum. Anything that's like If you look at Palo Alto Networks, that's a low momentum because it has been kind of like going up, then a pullback, then another up. So that would have a lower momentum factor. So right now, like the cybersecurity names would be on the low momentum side.
Yeah, and
like Rubrik is another one, right? Where like it's been bouncing up and down. So you want to have a little bit of both because momentum does very well over time. So you don't want to be like not exposed to that, right? But you want to have a combination of things.
Yeah, I agree. And this is where we align too. Like you mentioned Rubrik, and we've been buying Rubrik. Rubrik isn't, if you look at the metrics, it's not dirt cheap because you can't really call it dirt cheap because it's a SaaS name, right? But if you look at what it is, its growth and its peers, it's attractive. And I like to buy stocks. I like to buy stocks that I'm going to hold for a long time when no one else really wants them. So I kind of against the grain. Now, I'm not saying I just buy any dog, that's going to be sideways for a while. But if I think Rubrik is of value at a certain price, I'm going to buy it with a thought that the market will figure it out and it'll be a momentum name later, right? And yes, you want to keep those momentum names, but it's not value investing because you can't call it value investing because it's
not a cheap stock per se, exactly. And that's the thing with us. Like our slogan is like see value better. So we're like, oh, they must be doing like buying low P stocks, right? It's like, and then you look at the portfolio and it's like, wow, this is not low P. But yeah, I think value is another one where it really depends on how people define it. Like we've defined it as like you're trying to find fundamentally good idea where the fundamentals are better than what you're paying right now. It's not necessarily an idea that has a low P ratio.
Right.
Versus like quant funds define it differently, right? Would be more like based on the P ratio.
Yeah, when you think of like the retail investor that's a value investor, it's very much Warren Buffett, 10 PE, it's very, when you think of the quantitative analysis, right? You can measure it, it's easy to find, it's black and white. The qualitative analysis is what makes a growth investor a good growth investor because you have to have that vision and there's some story behind that. There is some speculation behind it. If it were as easy as checking off 10 boxes, it's got a low P ratio and this and this. I mean, that's too easy, right? It doesn't work that way. So
and technology just changes so rapidly. The winners of yesterday will have nothing to do with the winners of tomorrow. Even when you have companies that reach such scale, right? Like Apple is one good example. Like they literally have the entire market. People are like, how could this go wrong, right? But then you're looking at it and it's like, what are they coming up with on the AI side? Not much. It's interesting how like you can't really say, okay, I'm going to buy the Mach 7 and hold them forever because things could change. So you really need to be on top of things and making sure that you're owning the right companies.
Yeah, absolutely. And I think we agree on this, align on this too, but correct me if I'm wrong, but I think we would much rather buy a momentum name before the masses. That's the whole idea. If you have an edge with your research, you get in before everybody else knows about it. It's hard. And so you look at like an Astera Labs, you say, well, if you missed it from the run from 46 to 250, one school of thought is like, well, yeah, but it's going to be $1,000 stock in 5 years and it's still a good buy. Just keep buying at any price. And the other school of thought is me, where it's like, I am a growth investor, but I'm also very disciplined and I'm not necessarily, we are different in those ways because I can't actively just buy and sell all the time. I'm trying to ride themes for a longer period. I want to get in NVIDIA before everybody else does. I want to get in, some of these names. So like Rubrik, maybe it's one where you get in before everybody realizes that, hey, this actually has some legs. There's some real, because one of the big things that people say to me is, I don't want Rubrik because CrowdStrike can just do what they do if they wanted to. And this is where it gets really, it's a slippery slope because if you're looking for like a true moat, like a Coca-Cola, it's going to be really hard to find that in software. I mean, to your point, things are disrupted. Things change quickly. And so like, if you're looking for an impenetrable moat to hold for 30 years in cybersecurity SaaS, you're not going to find that. It does, you know what I mean? But you look at it like CrowdStrike partners with Rubrik. There's not really any reason to go after their business. They're very good at what they do. It's a very niche thing, right? And you look at best of breed for different niches and there can be sub segments. And I identify that as one that seems intriguing. And maybe it's wrong. I'm not going to put 10% in my portfolio, right? But I want to get in on that now before people jump in it. Palantir is one we bought in 2020. We didn't know EIP was going to exist yet, but we thought the company was cool for this and that. And there's two schools of thought there. You could say, well, you could have been buying more at $100 a share. Well, if I got in at $950, and this is again, DCA up, and some people are like, well, my cost base is low. And there's a fine line between anchoring bias and then just paying any price. And it can be very difficult because the new investor comes in, they're like, well, they're talking about Astera Labs. It's the best thing ever. I'm going to go put, 10% of my portfolio in at $260 a share. I personally wouldn't advise that. I don't know if you would, but you would rather get into it early, which you did. And then you have the ability to ride it as long as you want. And when you're ready to cut some profits, you can do that, and there's different schools of thought on that too. I like the DCA both directions.
Erica, one thing I would add here is that if you are buying with conviction, you just need to be fine with the leg down of 15 to 25%
or more.
Right. So what happens exactly. So like what happens with people, they're like, oh, I'm a long-term investor. And then the first time that something is down 15 to 25%, depending on the stock, these are like daily moves, right? Like it could be down 25% tomorrow, right? So if you're fine with that, then you're going to do very well over time, right? So a lot of these names that you buy, it really it's better if you can buy them well, but even if you don't buy them great, you will still make money over time, right?
You bought Astera Labs before everybody else and you rode the wave, and most of that is performance driven, right? And whether you agree on trimming or not, it's one thing. What I'm talking about is if I'm starting a new portfolio, I'm not just going to throw all of my eggs in that basket after it just did a massive nosebleed rip. And that's where that quant, a lot of times, if it says strong sell, if it's a high quality company, like, say it's a Rubrik and I do my research and it's telling me to sell, but the analysts are saying buy, it's like, well, this might show me that the technicals are starting to get washed out and it might be an opportunity. You start looking at then RSI's oversold and it's below the S3 Fibonacci. And, we use some technical analysis in our strategy. But, if you buy it when it says strong buy and you zoom out 6 months, a lot of times you're down on the stock. Now, 5 years from now, it could be a different story. But if you don't have the experience, you're a new investor, you think you have the mindset to stomach that kind of volatility. You talk about 15% of the day, it could be more than that, right? I mean,
for Astera Labs especially, right? That was like for an average, holding, right?
Yeah. So it's really interesting stuff. And I think it's just good to kind of connect those dots. This has been great. And like always, we could talk for hours, but I want to respect your time because I've already gone over that and my voice is starting to chop out anyway. Anything you want to finish up on before we go?
Nope. I think that was great. I love seeing you. I would say for disclosure purposes, all of our holdings are disclosed on our website. If people want to check them out real time, they're updated daily. Same as the prospectus for SPRX is posted on the website as well.
And to be clear, there is no sponsorship with this. It's just Ivana and I having a conversation. I do own some, full disclosure, I own some Spear Alpha ETF, SPRX, but I'm not paid to tell you to go buy it, but definitely explore it if you're interested in some of these names, especially if you want exposure to some of this momentum and maybe just, don't like to have as much risk in your portfolio. If you're one of those type of investors, it's a great way to kind of play that and let her do some of that heavy lifting for you and her team. So
yeah, and this is not a recommendation, right, to buy any security or whether it's Spear or any of the other ones. It's just us sharing our knowledge. So
yep, no financial advice, no payment, just two friends talking about stocks, and hopefully it was entertaining and educational. So thanks very much for your time, Ivana. Until next time, have a great rest of your day.
Thank you.
See you later.